Hi there. I want to talk to you about insurance, RSPs, wills, and estate planning. This will give us a good opportunity to talk about several different concepts. And the reason I'm going to talk to you about this is there's two tax acts. There's one for the informed and there's one for the uninformed. And the Tax Act is a series of rules that if you understand how to utilize it properly, you can significantly reduce your estate taxes anywhere from 15 to 25%. And that's incredibly meaningful money. So the first thing I'm going to talk about is insurance. And I call this my bubbles presentation. We have bubble A here. This is insurance, life insurance to be specific. And what most people understand is they understand you pay a premium. And let's just call it $2,000. So when you pay this premium to the insurance company, what happens? There's a provincial premium tax, 2%. There's an investment income tax. There is some expenses to get the policy underwritten. There are mortality charges. They have to set aside money because people die. And then finally, there's profit for the insurance company. No business is in business not to make money. And so with life insurance is a cash flow decision when you're young. I need it. I've got a young family. Instead of buying a new set of golf clubs, I pay my insurance premiums. But when you get older and you've accumulated some money, people often use the earnings off their investments to pay for things. So over here, we have bubble B, and this is your non-registered investments. And if I have $80,000 earning 5%, that's $4,000 a year. But see, in Canada, everything you earn is not yours to keep. You're in partnership with Ottawa. And if you're in the top tax bracket, 50% goes to Ottawa. So in this illustration, if you've got $80,000 earning 5%, that's $4,000 a year of interest income, $2,000 goes to Ottawa, $2,000 can be used to pay your insurance premium. You're paying for it, but it's not coming out of your personal cash flow. Section 148 of the Income Tax Act says a properly structured insurance contract is exempt from taxation. So what's that mean in language we can understand? It means you can take bubble B and put it inside bubble A. Why? Because it's exempt. So let's see what happens. I've got $80,000, I earn 5%. That's $4,000. I don't have to give money to Ottawa because it's exempt from taxation. That means I take $2,000 and I pay the insurance premium. The other $2,000 gets added to my investment. I have now $82,000. People will say, just a second, Lance, let me get this straight. What you're telling me, think of this as a street corner. And this is an investment firm. It could be RBC, it could be McKinsey, it could be CIBC. What you're telling me is if I walk my money out the street corner and I walk it to Manulife, Canada Life, Sun Life, or some other insurance company, I can have money invested and have it exempt from taxation inside a life insurance contract. What's the catch? There is no catch. Well, what can I invest in? Well, that depends on the type of contract you buy, but you could buy 1, 3, 5, 10-year GICs. You could buy indexes like the TSX, the NASDAQ, the S&P. You could buy up to 200 different types of mutual funds. People go, oh, that's quite interesting. But where it gets more interesting from an estate planning point of view, if Ottawa was paying for your life insurance, how much life insurance would you buy? And why do I say that? Well, before you were sending $2,000 to Ottawa. Now you're not. But here's what happens when you die. Let's say this was $1 million policy. When you die, the life insurance, bubble A, is paid out. And bubble B, although it's investments, it's paid out because of the Income Tax Act. It's paid out as a tax-free death benefit. People say, just a second, let me get this straight. I put my money in, it's exempt from taxation while I'm alive. The earnings on it paid for the life insurance. And when I die, the insurance and the investment account is paid out tax-free. So now let's take this a little bit further into estate planning. Most people have RSPs, and let's take a situation where the husband and the wife each have $750,000 in their RSP. Now, when the husband dies, under the Tax Act, the RSPs can roll to the wife. She now has $1.5 million. What happens when she dies? The way the tax code is written is in the year of death, you're deemed to have sold and deregistered your RSPs, or if you're over age 71, it's called a RIF. I got a question for you. If you had income in Canada of 1.5 million, you're in a 53% tax bracket. People go, hey, you mean a lifetime of savings? When I die, half of it goes to the government? And I'm like, yeah, those are the rules, man. When you put the money in, you got to deduct it from your income. When you take it out, you pay tax on it. And when you die, you got to take it all into income. Now, this is estate planning. I'll sum it up in three things. A little triangle. You have family, you have charity, and you have government. This is estate planning. Pick two. And if you pick the wrong one, you don't get to be a client of our firm. I always joke when I say that. But here's the thing is, you have an estate plan whether you want one or not. And most people go, Lance, I would prefer the money to go to family and charity. And I'm going to explain how we can tie these concepts together so that Ottawa gets the square root of zero. They get no money. See, what happened is a number of years ago, the government changed the Income Tax Act as it relates to estate planning. You can buy life insurance policies on what to know as individual, or you can buy what's known as a joint and last to die policy. So if my wife and I bought one, it's not based on my age and it's not based on my wife's age. It's based on when the actuaries think the second of us will die. I got a question for you. If someone gave $1 million to a charity in the City of London, because that's where I'm located, do you think it would hit the front page of the London Free Press? And you know what? It would. I've got a newspaper article where a retired school teacher made $1 million donation to a charity, hit the front page. Why? Because it makes a significant difference to the community. Guess what? There is someone in the City of London that died last year. Their estate wrote $1 million check to Ottawa. It's just wasted. And so most people say, well, how can I do that? Well, here's the thing. The government changed the rule that in the year of death, instead of a tax credit for charitable contribution, it's a deduction against income. So let's take this to an estate planning perspective. I'm going to change this. You've got a $1.5 million joint and last to die life insurance policy. We have $1.5 million in RSP. When my wife dies, if she doesn't have the life insurance, she owes $750,000. So our children get $750,000 less because Ottawa gets $750,000. But because we got Ottawa to buy our life insurance many years ago, when the second one of us dies, or in your case, the second one of you die, this life insurance goes to a charity. It could be the Memorial Boys and Girls Club, it could be London Health Science Centre, it could be the YMCA. So now, money gets paid to a charity, the charity issues a $1.5 million tax receipt. There's $1.5 million of taxable income that gets negated. So people say, so let me get this straight, Lance. I took money that was exposed to taxation. I sheltered it in an insurance policy that's going to pay out on the second one of ours death. If I need access to the money while I'm alive, I can get access to it. My investments grow significantly and we spend them. When I die, they roll to my wife. When my wife dies, our kids get 100% of all our investments, our house, because this life insurance policy that Ottawa paid for got given to a charity, and the Income Tax Act allows a deduction against income in the year of death. People go, why haven't I heard of this before? And see, one of the jobs of a financial planner is people go, I understand this data point. I didn't know that. I kind of knew that, and I'm familiar with that. And all a financial planner does is connect the dots. And so the question is, which two are you going to pick? Because two are going to be picked no matter what. I hope you found this little video of interest. And if you'd like to have a conversation how it may or may not apply in your situation, my contact information is below. So thank you for watching, and remember, live well, pay less tax.